Okay, so chapter 29, we're going to focus on the aggregate expenditures model. Okay, so we're going to make some assumptions and, as a way to simplify things. So we're going to use the Keynesian aggregate expenditures model, which assumes that prices are fixed. John Maynard Keynes, made this assumption because even during the Great Depression, prices did drop, but not enough to really boost spending and enough to maintain output and employment at their pre-depression levels. So we're going to assume that prices are fixed. They don't change at all in reality. Prices will change, but they're sticky. They're very slow to change. Also, the other assumption we're going to make is that GDP will equal disposable income. So if there's $1 trillion worth of output, then households will receive $1 trillion of income, and then they will either consume or save that income. We're going to begin with a private closed economy, meaning we do not engage in international trade. Therefore, there are not net exports, so no exports, no imports. And we will look at consumption spending and investment spending. Okay, as said before, in the closed economy, the two components of aggregate expenditures are consumption and investment spending, more specifically gross investment. Okay, so we have on the left the investment demand curve, and this shows the various levels of investment that firms plan to take under different rates of return. So if the rate of return was 8%, okay, then firms plan to engage in $20 billion worth of investment spending. And now that we have this amount, we can look at the investment schedule. And so we have that $20 billion amount here. Okay, so here it's on the vertical axis, investment spending. And investment schedule is horizontal. So what this means is that if GDP is low, let's say it's at point A, or if GDP is higher, that firms plan to still spend $20 billion on investment spending. So it doesn't matter if GDP is high or low. Firms solely base their decision on the real interest rate, not on levels of GDP. Okay, GDP will be in equilibrium when real domestic output, like we said earlier, equals aggregate expenditure. Okay, so the first column is possible levels of employment. So, for example, row 1 would be 40 million persons employed. Row 2 would be 45 million persons employed. The second column is real domestic output. Essentially, this is how much the economy produces. 3 is consumption spending. 4 is saving. 5 is investment. 6 is aggregate expenditure, which in a private closed economy would be columns 3 and 5 added together. 7 is unplanned changes in inventory, which is the difference between column 2 and column 6. So we have in row 1, okay, output is 370, aggregate expenditures is 395. The difference between those two is negative 25. Row 2, 390, aggregate expenditure is 410. The difference is negative 20, etc. And then column 8 will say, the tendency of employment, output, and income, is a tendency to increase, decrease, or will it be in equilibrium? And we find this depends on column 7. Okay, so as we said, unplanned changes in inventory here were negative 25 for, let's say, row 1. So if aggregate expenditure, if consumption spending and investment spending together was 395, but output was only 370, that means consumers and firms demanded more goods and services than what were produced. So firms need to catch up to this spending, to this demand. And so they will increase output, which means they will also hire more persons to work, and income will also increase. Row 2, again, expenditure spending was higher than output. So there is a demand for output. So firms will increase output, increase employment. This will increase all incomes, and so on. Now let's look at at row 7. Okay. Spending was 485. Okay. But output was 490. Okay, so there's an increase in inventories of 5 here, which means that there was more produced than there was demand for. So since there's not enough demand to produce more, okay, output decreases, then employment decreases, which increases income, etc. And then if we look at 6, which is already highlighted in a darker blue, okay, this is where we have equilibrium, where output equals aggregate expenditures over here. So spending on investment goods and consumption goods equals what the economy produced, and we have equilibrium. So this is the equilibrium point. It is where there will be no unplanned changes in inventory and where aggregate expenditures equals real domestic output, or GDP. All right, so graphing equilibrium GDP in a private closed economy. So we have our reference point here, and that's the 45-degree line. And okay, this is where any point on this black reference line is where aggregate expenditures equals GDP over here. Okay, so if we're at this, let's say this is point A, okay, then aggregate expenditures at this point will equal GDP. So any point along the black reference line, aggregate expenditures equals GDP. All right, so we have consumption alone, okay, and then we have consumption plus investment spending. So if investment spending, it's usually positive, so this will shift the line upwards, and where it intersects the reference line is our equilibrium at $470 billion in output and in aggregate expenditures. Okay, and the difference between the darker blue line and the purple line, okay, that will be investment, because this is consumption alone. Once you add in investment, it shifts up, so the difference between the two over here is investment spending. Okay, at equilibrium GDP, savings equals planned investment. Okay, savings is what we can say a leakage of spending. What exactly is a leakage? Is basically a withdrawal of spending. It's money that could have been spent on output, but instead it's not being spent of output. It's either being saved, or it's being used to make a tax payment, or it's being spent on imports. And any time savings is greater than investment, or planned investment, then the consumption of output is less than total output. Okay, but also firms don't always intend to sell everything they produce to consumers. Some of it will be sold to businesses as capital goods. And so anytime there's investment spending, okay, that's an injection of spending into the economy. So what exactly is an injection? It's just the addition of spending. It can be applied to investment, government purchases, or net exports, or consumption. In this case, it's a private closed economy, so net exports goes away. If investment spending is greater than saving, then this will increase GDP upward. And how can you tell in the graph which one is which. Okay, so anytime aggregate expenditures is less than output, in this case, there is savings. So, let's say a couple slides back to the table, row 7, we see that output was 490, but aggregate expenditures was 485. So there we have a savings level. Okay, this is income that has not been spent, so therefore it is savings of 5 billion. And anytime aggregate expenditures exceeds output, then there's been an increase in investment spending or an injection of investment. Okay, unplanned changes in inventories. These are changes in inventories that firms did not expect. And at the equilibrium level of GDP, there are no unplanned changes in inventory. If you go back to the table a couple slides back at our equilibrium at row 6, you could see that unplanned changes in inventories were 0. Therefore, since output equals aggregate expenditures, firms will not increase or decrease production. Now, if unplanned changes in inventory is positive, then that means that aggregate expenditures is greater than output, and firms will increase production here because there's demand for it. If it's negative, they will decrease production because firms and consumers are not buying all the goods that are being produced, so they slow down production until those level of goods are bought. All right, and we can see changes in equilibrium GDP in graphical form. Okay, we start off at C plus IG aggregate expenditures 0 over here, dark blue line, and equilibrium GDP is 470 and aggregate expenditures equals 470. So remember, with this reference line, any point on it means AE equals GDP. Okay, so let's say there's been a decrease in investment. So C is the same, but IG is lower. So this will shift the line downward. And I'll write it out here. Okay, so equilibrium output and GDP drop. And if there's been an increase in investments from the original line, then it will shift upward. And the new equilibrium GDP and output, equilibrium aggregate expenditures and GDP is higher, as we can see. So increase in consumption spending or increase in investment will shift the line upward. Any type of decrease will shift it downward. And we can see, this intuitively makes sense because in the closed economy, GDP is C plus I. So if C or I decreases, C and or I rather decreases, then GDP will decrease. And we saw it here when investment decreased, GDP decreased. And if C and or I increase, then GDP will increase as well through the shifts. All right, so if we were going to look at a private open economy, then we can include net exports, and this is the more realistic scenario since we do engage in international trade. Exports can be great for an economy. They increase production, employment, increase income. The more we produce and sell abroad, the more of our GDP it affects positively. There's a lot of economies out there like Germany that are very export based. A lot of Germany's income comes from being an export powerhouse. We do subtract spending on imports from GDP. Why? Because again, GDP is the market value of all final goods and services within a country, and since imports are not produced within our borders, they are not included in GDP. And we subtract it though because it's still spending. And so net exports can be positive or negative. So Germany's net exports is positive. It adds overall to their GDP. The United States is negative. It's been negative since the 70s, and it takes away from our GDP. All right, so this schedule shows two hypothetical scenarios for the levels of GDP. The first scenario is when exports are greater than imports, so this economy would have a positive net exports. And then the second scenario is when exports are less than imports, and so the economy would have a negative net exports. And what we're also going to assume is that in both these scenarios that net exports is independent of GDP, so you can see that whether the level of spending is 370 billion or 470 billion, net exports is still, for 2 it's positive 5, for scenario 3 it's negative 5 billion. Okay, so positive net exports, when we start with C plus G, let's say over here, okay, this is our regular line, this is not C plus G, C plus investment, okay, aggregate expenditures. And then with positive net exports, it would actually shift the aggregate expenditures line upward. Why? Because now when the economy is open and there's positive net exports, it's C plus I plus XN. That's a positive number. And when it's negative net exports and the economy is open and net exports are negative, since negative exports take away from GDP, this aggregate expenditures shift downward. Okay. And so we see here that GDP is less. So we see here that positive net exports added 5 billion to GDP and negative net exports subtracted 5 billion at all levels of GDP. So whether GDP started at 450 or at 470 or at 490, positive net exports added 5 billion to each of these numbers, or negative net exports took away 5 billion from each of these numbers. Okay, so when our economic trading partners are doing well, this helps the U.S. out. So whenever Canada, Mexico, China, or Europe, they're doing very well economically and their incomes go up, then that means they have more money to be able to spend on U.S. exports. And the reverse scenario is true. The U.S. could be doing well, but if Mexico and Canada are in a recession, then spending on U.S. exports tends to drop. Also, exchange rates affects U.S. net exports. So whenever the dollar depreciates against another currency, that means the other currency can buy more U.S. dollars. So U.S. goods are relatively cheap to them, and so U.S. exports get a boost. However, when our dollar appreciates against another currency, that means it has gained strength. That means the foreign country can now afford less U.S. dollars since their currency is weaker, and so U.S. net exports drop. So an example will be lately the euro has been weakening against the dollar. It's been depreciating, and the dollar has been appreciating, gaining strength against the euro. So for Europeans, U.S. goods are now relatively more expensive, so they decrease their spending on U.S. exports. However, we've increased our spending on their exports, so we're buying more European imports, in other words, because our dollar is stronger now, and so their goods seem cheaper because the dollar can now buy more euros. Okay, so let's talk a little bit about tariffs and quotas. A tariff is a tax on an import. A quota is a limit on the number of imports that can be brought in of a certain good. And, countries will try to boost their own exports and then their own products. So, if we don't want, for example, U.S. citizens to buy foreign cars, we might put a quota or a tariff on foreign cars so we can buy American cars only. But the thing is that, once we start slapping quotas and tariffs on another country, they may retaliate in the very same way. And what we found that there's always a deadweight loss associated with this. So the best way is just free trade. And also, there's a temptation to devalue the currency by supplying a lot of that currency in the foreign exchange market. And, that would provide a boost in exports, but then if other countries start doing the same, it just turns out into this game of chicken. And so what we find is we should, again, not devalue, just let the free market takes place. All right, in 2012, China, Germany, France, Italy, they have positive net exports. Canada is almost balanced. Japan, UK, and definitely the US has negative net exports. So these countries over here export more than they import, and then Japan, United Kingdom, United States, we import more than we export. Okay, so up until now we have assumed first that it was a private closed economy, so we just had C plus IG. Then it was a private open economy, so we have C plus I plus NX, and now we're going to have a public open economy, which means we're adding in the public sector. So we are now including government spending. All right. So government spending is subject to the multiplier. And also taxes are subject to the multiplier as well. Okay. The multiplier depends on the marginal propensity to consume. Okay. So now equilibrium GDP is equal to disposable income after that households receive after they're done paying their taxes. All right, so we can map out equilibrium GDP here when we add in government purchases. Okay, here right now we're not showing taxes. We're assuming no taxes right now. And so we see, since we're a public open economy now, GDP will equal C plus I plus G plus XN. So we have the sum of that over here. Okay. So column 2, consumption. Column 4, investment spending. Column 5, net exports, and column 6, government purchases. Remember, we don't add savings, which is column 3. It's not part of the equation for GDP, so it's not included in aggregate expenditures. Okay, and so where we have GDP equal aggregate expenditures, that's our equilibrium. And here it's row 10. Okay. In all these other levels, expenditures is higher than real GDP. So for example, row 1, it's 415, GDP is 370. Row 6, it's aggregate expenditures 490, GDP is 470. In this case, there's room for production. Spending is higher than current production. So firms will increase their output to meet the higher levels of spending, and so employment will fall, output increases, and unemployment will fall as well. Okay, and so if we were to graph this out here, so here we just have consumption. Okay, and then let's say we are a private open economy, then we have consumption, investment spending, net exports, and then when we add in government spending, okay, this increases aggregate expenditures even further, and we see that going from just consumption alone to consumption, investment spending, net exports, and government spending increases the equilibrium GDP to 550. So here we have aggregate expenditures, 550 equals equilibrium GDP of 550. Okay, let's look at the more realistic scenario here, and this one includes taxes. So just for simplicity's sake, we're going to assume the government implements a lump sum tax. What's a lump sum tax? And this is a constant amount that is collected at all levels of GDP. So in this case, it's $20 billion worth of taxes collected at all levels of GDP. So whether GDP is 370 billion or 550 billion, the amount of tax that's collected is 20 billion. So this then will definitely affect consumption and, of course, saving. So first we look in column 3, and remember, in a open public economy, GDP will equal disposable income, and disposable income here is 1, which is GDP, minus the taxes, which is column 2. So you can see for row 1, 370 minus 20, we get $350 billion in disposable income. Row 2, 390 billion minus 20 billion, again in taxes, equals 370 billion in disposable income, etc. And now, how much taxes reduce consumption and saving depends on the marginal propensity to consume and the marginal propensity to save. So in this case, the marginal propensity to consume is 0.75. And how do we figure this out? We figure this out by looking at the change in consumption in relative to change in output here. So going from row 1 to row 2, okay, the change in consumption is 15. So 375 minus 360 gives us 15, divided by, and here the change in output and income, so 390 minus 370, that's 20. Okay, and that gives us 0.75. And then we can do that all along, from rows 2 to 3, again, the change in consumption is 15 and the change in income is 20, and so etc. So we find here that consumption is reduced by 15 billion at each level. Okay, so we take the 20 billion in taxes, multiply by the marginal propensity to consume, okay, and we get 15 billion. Okay, so if you look at consumption in the first table we did without taxation and consumption at this table with taxation, you'll see that at each level of output and income, at each row, essentially, consumption is 15 billion less than it was at the last table. And then also saving, so marginal propensity to save is 0.25. Okay, so remember, they have to equal 1. So if marginal propensity to consume is 0.75, then marginal propensity to save is 0.25. Or you could find it by doing the change in savings over the change in total income. So you could do, like, for example, the change in savings here is 5 divided by change in income, again, is 20 over here. All right, so, and then we would multiply 20 billion by 0.25, and we get the change in savings is 5 billion. So savings in this table is 5 billion less than savings in the first table without consumption. Okay, and so this will change equilibrium GDP. So before, equilibrium GDP was 550 billion, but here, because of because of taxes, dropping consumption, which then also drops output, right? We're not spending as much as we were before when we had no taxes, so then it also drops demand for output, etc. The equilibrium GDP is 490 billion. Okay, so we add up C, column 4, I, column 6, G, column 8, and then net exports, column 7. Okay, so taxes reduce consumption, reduce savings, and reduce equilibrium GDP. Now, of course, here we're assuming the government hasn't changed their spending. Notice here it's remained constant. Now, if the government were to increase their spending, for example, then we would have a positive multiplier effect going on, and it could increase GDP and help offset the decrease in consumption that taxes cause. All right, and putting this in graph form, right? So let's say we start here without taxes, and then we increase taxes. So aggregate expenditures, okay, will shift downward. And as we see, equilibrium GDP has dropped. So anytime equilibrium GDP does not equal the full employment GDP, then we can say we have expenditure gaps. Okay. A recession expenditure gap is caused when aggregate spending isn't enough to reach full employment GDP. And so the way John Maynard Keynes said the government can play a role in helping increase aggregate spending to reach full employment GDP is to increase government spending and or decrease taxes. So it can be changing taxes alone, changing government spending alone, or a combination of the two. When there's an inflationary expenditure gap, that's when aggregate spending is so high that GDP is above full employment GDP. And so we call this inflationary because when an aggregate spending is high like this, it causes inflation. It's what we call inflationary boom. And it's not necessarily a bad thing, but we don't want the inflation rate to get too high too fast, because that is how bubbles are created. And since prices are sticky, the first thing that would rise are the prices in goods and services, and then wages are much slower to rise. So living standards in the short term would definitely increase significantly. And so the way the government can help control this inflation and reduce, potential for acid bubbles is by decreasing government spending and or increasing taxes. All right, so let's say we have a recessionary expenditure gap. Spending is not enough to be at full employment, so we are currently at this point. Okay, so the government can decrease taxes and or increase G, and this would shift aggregate expenditures upward, and so we would be at the full employment output of should be 510. Okay. All right, and over here, full employment output is 510, but we are currently at 530, and so we want to make sure inflation doesn't become a problem and acid bubbles don't occur. And so the government can shift this downward by increasing taxes and or decreasing government spending. Okay. So in 2007, there were a lot of forces at work that created the 2007 recession, and they had begun from policies years before, and we'll go into it in other chapters, but essentially the housing bubble collapsed. A lot of banks went under, and aggregate expenditures significantly declined. Consumption declined, investment significantly declined, and there was a recessionary expenditure gap. In fact, overall GDP declined by a total of $1 trillion, which is very significant during that time period from when it began to when the recession ended. So the government, did undertake some policies to increase aggregate expenditures. We had the tax rebate checks, so we got some of our money that we paid in taxes back. There was also cash for clunkers. You could trade in your old car, get some cash, and so the government was hoping you would go and spend it on goods. But what ended up happening is households were so scared that they ended up saving their cash. There was a $778 billion stimulus package. Unemployment benefits were extended, etc. And didn't necessarily resolve the recession of 07 to 09, but did help alleviate some of it. And so if you believe government should play a role in helping stabilize the economy, then you call the Keynesian economist. John Maynard Keynes rose to, I guess, stardom during the Great Depression. He was saying that government needs to increase spending, decrease taxes, and help stimulate the economy. But his focus was really on government spending. And then sure enough, when World War II came, government spending increased tenfold and pulled the U.S. economy out of the depression it was in. So John Maynard Keynes gained a lot of prominence through his theories, in that the government should play a big role in correcting recessions, depressions, and also if there's an inflationary boom, to help decrease a little bit of that high growth rate, so that way asset bubbles are prevented and inflation doesn't become too high. So classical economists will go by Say's law, and this is essentially that the production of output provides the income needed to buy that output. And so the economy does not need any type of intervention. It's laissez-faire policy, which is basically hands off. If there's a recession, don't have any government policy, such as an increase in government spending, lowering of taxes, or if there's a boom, once again, let the economy leave the economy alone. And then Keynesian economists will say that the economy will not correct itself. During the Great Depression, the economy did not correct itself. Prices stayed depressed. There was very little growth, and that the government should play a more active role in stabilization. And even current Keynesians will say, look at Japan. They had the last 2 decades where their GDP did not grow at all, and so the government should have played a bigger role in helping increase their GDP and helping them achieve levels of growth again. And so they say the U.S. cannot fall into that, and so government should play a bigger role. So there's pros and cons to each theory. Of course, everything comes with a trade-off over there, and we'll discuss this more. All right, so this concludes chapter 29.